Hello everyone, welcome back to Upstart. I hope you are doing very well. In today's video I am going to talk on the differences between owning an LLC and S-Corporation based on their uniqueness, protection, taxation and drawback to consider. Choosing the right business type is important to the success of your business. Find out whether your company should be an LLC or S-Corporation. So, what is an LLC? An LLC stands for Limited Liability Company, is a business structure that protects the personal assets of the business owners, also referred to as a members. If the business gets tangled in legal troubles or is sued by a debt collector, the plaintiff or creditor can only go after the business assets, not the personal assets of the LLC members. To better understand an LLC, you first need to understand the piercing the corporate veil. It refers to a situation in which courts put aside limited liability and hold a corporation's shareholders and directors personally liable for the corporation's actions or debts. Veil piercing is most common in close corporations. Pros of an LLC. Better for maximum flexibility in how you can manage and run your business. Board of directors are not required in an LLC. You can have an unlimited numbers of owners, also known as members. You can form an LLC as little as one person. Members are protected from debt collectors or creditors if the company runs into legal issues or debt. Now, let's learn how protection and taxation works in an LLC. In an LLC, you are not personally on the hook for business liabilities. Taxation are done once or twice a year. You are free to choose which can help minimize the taxes. LLC members must pay self-employment tax on their income rather than filing a corporate tax return. Members report earnings on their personal tax returns. The business remaining profits are distributed as dividends. There are a few disadvantages to creating an LLC, although in many cases the advantages outweigh the drawbacks. An LLC usually costs more to form and maintain than a sole proprietorship or general partnership. States charge an initial formation fee. Many states also impose ongoing fees, such as annual report or franchise tax fees. Check with your Secretary of State's office. Ownership in an LLC is often harder to transfer than with a corporation. Typically, with LLCs, unless the members agree otherwise, all members must approve adding new members or altering the ownership percentages of existing members. An LLC is not recognized globally. You may be taxed as a corporation in other countries. An LLC can't go public. An S-Corporation, also referred to as an S-Corp, is a tax election that lets the IRS know your business needs to be taxed as a partnership. It also prevents your business from incurring corporate-level double taxation. To become an S-Corp, your business first must register as a C corporation or LLC. In an S-Corp, the business owners are called shareholders. As an owner, you are considered an employee of the business and must pay yourself a reasonable salary. To qualify as an S-Corp, your business can have 1 to 100 shareholders. One major advantage of an S-Corporation is that it provides owners limited liability protection, regardless of its tax status. The tax benefit for S-Corporations is that business income, as well as many tax deductions, credits, and losses, are passed through to the owners rather than being taxed at the corporate level. This avoids the chance of double taxation which occurs with C corporations when dividend income is taxed first at the corporate level and then at the shareholder level. An S-Corporation owner can opt to receive both salary and dividend payments from the corporation. This can result in a lower tax bill overall. If S-Corporation shareholders want to be taxed as a C corporation, all that's required is filing this election with the IRS. Generally, an S-Corporation is exempt from federal income tax other than tax on certain capital gains and passive income. It is treated in the same way as a partnership, in that generally taxes are not paid at the corporate level. You're not personally on the hook for business liabilities. The owners of an S-Corp pay regular income tax on their distribution, but they are not considered to be self-employed, so they pay no self-employment tax on this distribution. If any of the owners also are employees, they receive a salary from which FICA taxes are withheld. An S-Corp's profits, losses, deductions, and credits are taxed at the shareholder level. There are a few disadvantages to creating an S-Corporation. There is an ongoing filings and fees to stay in compliance. Less management flexibility. They must have a board of directors. More admin, strict rules about holding meetings and keeping records. All shareholders must be U.S. citizens or residents. The company must be located in the United States. Choosing the right business type is important to the success of your business. Find out whether your company should be an LLC or S corporation. Filing to become an LLC is a good approach to begin with because this structure offers liability protection and tax write-offs. However, as your business grows beyond the startup stage, switching to an S corporation may make financial sense. S-Corp may make more sense financially for many businesses, but unless there is a specific reason to make the switch, it may not be the best move for a single-member LLC. I personally like the flexibility that LLCs offer business owners. In my next video, I will show you how you can find an online resources to file your own LLC. So, if you haven't yet subscribed my channel, please subscribe my channel for more useful videos and don't forget to hit the bell icon for the notifications.